January 11th, 2026, 2:34 p.m. Beijing time, China's State Administration of Foreign Exchange releases quarterly data confirming that Chinese holdings of US Treasury securities declined by an additional $68 billion during the final quarter of 2025. This extends a methodical reduction that has eliminated over $500 billion from peak holdings of $1.3 trillion in 2013. The cumulative withdrawal, $500 billion, no longer finances American deficit spending. Within minutes of the release, US Treasury yields spike 14 basis points as markets calculate reduced foreign demand from the world's second largest economy. I've analysed sovereign debt dynamics for 45 years. I briefed central banks on reserve management when dollar's dominance appeared structurally permanent and strategically unchallengeable. And what China is executing isn't portfolio adjustment or routine diversification. It's systematic extraction from dollar-denominated assets that eliminates strategic vulnerability while constructing alternative financial architecture capable of fragmenting the monetary system that has operated under American dominance since the Bretton Woods collapse in 1971. Let me show you how $500 billion in Treasury sales represents the visible edge of a structural transformation that will reshape global economics for generations. This current international monetary system grants the United States what French Finance Minister Valéry Giscard d'Estaing famously called an exorbitant privilege in 1965. This privilege operates through mechanisms most Americans never consider, but which fundamentally shape their economic experience. Understanding this system is essential to grasping why China's actions matter so profoundly. When Richard Nixon ended dollar convertibility to gold in August 1971, economists predicted the dollar would collapse without metallic backing. Instead, the dollar strengthened its position as the global reserve currency through a different mechanism, structural necessity embedded in international trade architecture. The system works through self-reinforcing demand. International trade requires a common settlement currency. Commodities including oil, wheat, copper and natural gas are priced in dollars. This creates automatic dollar demand. Countries need dollars to purchase these commodities regardless of their bilateral trade relationships. A Japanese company buying Brazilian iron ore must obtain dollars to complete the transaction even though neither buyer nor seller is American. This structural demand allows the United States to run persistent trade deficits without facing immediate consequences. When America imports more than it exports, a condition that has existed continuously for over 40 years, dollars flow overseas. But those dollars must be invested somewhere. Foreign central banks historically purchased US Treasury securities, effectively lending the money back to America to finance government deficits. The mathematics are extraordinary. The United States represents less than 5% of global population, but consumes approximately 25% of the world's resources. This consumption level is sustainable only because the dollar system allows America to import goods and services beyond what it produces, while foreign entities accept dollars in payment and reinvest them in dollar-denominated assets. China played the largest single role in sustaining this system. At peak accumulation in 2013, China held over $1.3 trillion in US Treasuries, more than the entire annual economic output of countries like Mexico, Spain, or Indonesia. Chinese manufacturers exported goods to American consumers. Chinese government accumulated the dollar payments. Chinese central bank invested those dollars in US Treasury securities, effectively financing American government spending. Economists describe this as mutually beneficial arrangement. America received cheap consumer goods and low-cost deficit financing. China gained access to the world's largest consumer market while building industrial capacity that employed hundreds of millions of workers. The cycle appeared stable, even symbiotic. But that description concealed a power asymmetry that became increasingly intolerable from Beijing's perspective. By holding over $1 trillion in US assets, China made itself hostage to American financial power. If Washington decided to freeze those assets, to impose sanctions, or to weaponize dollar clearing systems, China would be vulnerable. And that vulnerability wasn't theoretical, it was demonstrated repeatedly and dramatically. February 24, 2022, Russian forces enter Ukraine. Within 72 hours, the Western response included financial measures unprecedented in scope and aggression. The United States and European allies froze approximately $300 billion in Russian central bank reserves, sovereign assets supposedly protected under international law and custom. Let that number settle. $300 billion in central bank reserves accumulated over years through trade surpluses and resource exports suddenly inaccessible. Russia couldn't use these funds to support its currency, to pay for imports, or to manage financial stability. The reserves existed in ledgers, but were effectively confiscated through coordinated government action. This event represented a defining moment in international finance. Whatever one's views on the Ukraine conflict or Russian culpability, the asset freeze demonstrated unambiguously that dollar-denominated reserves, even central bank holdings traditionally considered sacrosanct, could be weaponized when the United States deemed it strategically necessary. Chinese leadership watched these events with intense focus. Multiple leaked internal discussions suggested Chinese officials calculated that similar actions targeting China were not hypothetical but probable if serious confrontation emerged over Taiwan, trade policy, or regional military competition. The Pentagon had explicitly identified China as America's primary strategic challenge. Washington was constructing military alliances throughout Asia specifically designed to contain Chinese influence. Technology restrictions were tightening, trade barriers were rising, and simultaneously China held $800 to $900 billion in US Treasury securities, assets that this same government could freeze with an executive order if relations deteriorated sufficiently. The strategic calculation became unavoidable. Maintaining these holdings provided minimal returns while creating catastrophic vulnerability. The only rational response was systematic extraction. The Russian precedent changed the risk assessment fundamentally. Before February 2022, freezing central bank reserves seemed unlikely despite theoretical possibility. After February 2022, it was demonstrated reality. Chinese officials could no longer dismiss the risk as remote or manageable. They watched Russia lose access to $300 billion and understood clearly the same could happen to China. China's response wasn't panic selling or hasty liquidation. The extraction began years before the Ukraine crisis, but accelerated dramatically afterward. US Treasury Department data reveals the pattern clearly. From peak holdings of $1.316 trillion in late 2013, Chinese positions declined to $188 trillion by 2018, then $1.068 trillion by 2020, then $939 billion by 2023, reaching approximately $797 billion by late 2025. The cumulative reduction exceeds $500 billion, half a trillion dollars removed from US debt markets over 12 years. This wasn't accident or coincidence. It was deliberate strategy executed methodically to avoid triggering market disruptions that would destroy the value of remaining holdings. Selling $500 billion in Treasury securities without crashing prices requires sophisticated execution. If China dumped holdings all at once, Treasury prices would collapse, yields would spike, and China would realize massive losses on its remaining positions. Instead, Chinese officials sold gradually over years, allowing markets to absorb supply without panic, while minimizing price impact on continuing holdings. The sales accelerated after 2022. In 2023 alone, China reduced Treasury holdings by approximately $110 billion. In 2024, another $97 billion. The pace reflected urgency created by watching Russian reserves frozen. Chinese leadership concluded that accepting gradual losses through orderly sales was preferable to maintaining exposure that could be eliminated entirely through American government action. But extraction was only half the strategy. The other half involved building alternatives, financial infrastructure that would enable Chinese economic activity without dollar dependence. This construction project represents decades of investment creating parallel systems capable of handling international transactions, storing wealth, and settling trade outside Western-controlled mechanisms. China didn't just reduce Treasury holdings, it constructed comprehensive alternatives enabling economic activity without dollar intermediation. This infrastructure took years to build and cannot be easily replicated or displaced. First, gold accumulation. China has been among the world's largest gold buyers for over a decade. The People's Bank of China doesn't publish precise holdings, and this opacity is strategically intentional. Conservative estimates suggest Chinese reserves exceed 4,000 tonnes, possibly approaching 6,000 tonnes, depending on purchases through non-public channels. Gold provides ultimate protection against financial weaponization. Unlike Treasury securities that exist in electronic ledgers subject to American control, physical gold cannot be frozen or sanctioned. It retains value regardless of geopolitical conditions. It can be sold for any currency or used as collateral for loans. Its physical nature makes it immune to the digital finance manipulation that enables asset freezes. Second, CIPS, the Cross-Border Interbank Payment System. Launched in 2015, CIPS provides alternative to SWIFT, the messaging network that facilitates international bank transfers. SWIFT operates under significant American and European influence. The United States has repeatedly used SWIFT access as a sanctions mechanism, cutting targeted countries off from international payment systems. CIPS allows China to move money internationally without depending on systems Washington controls. By 2025, over 1,300 financial institutions across 100-plus countries had connected to CIPS, processing over $50 trillion in annual transactions. This demonstrates that international payments can operate outside American-dominated infrastructure. Third, currency internationalization. China has systematically promoted yuan usage in international trade through multiple mechanisms. Bilateral currency swap agreements allow central banks to exchange local currencies for yuan, providing liquidity for trade settlement without dollar conversion. China has signed these agreements with countries representing over 40% of global GDP. Yuan clearing centres in major financial hubs, London, Frankfurt, Singapore, Hong Kong, enable businesses to invoice and settle transactions in yuan rather than dollars. The share of Chinese foreign trade denominated in yuan has increased from minimal levels in 2010 to approximately 30% by 2025. Fourth, Belt and Road Initiative infrastructure. Chinese-funded projects throughout Asia, Africa, and Latin America create trade relationships that naturally gravitate toward yuan settlement. When China finances a port in Pakistan or a railway in Kenya, the resulting commerce typically settles in yuan rather than dollars, establishing geographic zones where dollar relevance declines while yuan usage expands organically. These systems aren't fully mature replacements for dollar dominance, but they're operational and growing. More importantly, they demonstrate that alternatives exist. Countries concerned about dollar system vulnerability now have choices. They can diversify reserves, settle trade in multiple currencies, and reduce exposure to American financial control. China's actions triggered responses from other countries recognizing similar vulnerabilities. If the United States can freeze Russian reserves and if China is reducing Treasury holdings, what does that mean for other nations' dollar-denominated assets? Japan, historically the second largest foreign holder of US Treasuries, has reduced positions from peak holdings exceeding $1.2 trillion to approximately $1.0 trillion currently. Japanese motivations differ from China's. Aging demographics require repatriating assets to fund domestic needs, but the effect is identical. Another major buyer has withdrawn from Treasury markets. Saudi Arabia represents a particularly significant shift. For decades, the petrodollar system, where oil trades exclusively in dollars, created automatic dollar demand globally. The 1974 agreement between the United States and Saudi Arabia, whereby Saudis would price oil in dollars and recycle petrodollars through US banks, formed a pillar of dollar dominance. That arrangement is fracturing. In 2023, Saudi officials confirmed willingness to accept Yuan for oil sales to China. By 2025, approximately 15% of Saudi oil exports settle in non-dollar currencies, primarily Yuan. This breaks the automatic linkage between energy consumption and dollar demand. When buyers can purchase oil in alternative currencies, they need fewer dollar reserves, reducing Treasury demand proportionally. Central banks globally are buying gold at levels unseen in decades. According to World Gold Council data, central banks purchased over 1,000 tonnes in 2024 alone, the highest annual acquisition in modern records. They're converting dollar-denominated paper assets into physical metal that provides protection against financial weaponization. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively constructing alternative financial architecture. The new development bank provides project financing without IMF-style conditionality. The contingent reserve arrangement offers liquidity support during crises without requiring dollar borrowing. Currency discussions aim to create settlement mechanisms, enabling intra-BRICS trade without dollar intermediation. These developments individually seem modest compared to dollar system scale, but collectively they represent gradual construction of parallel infrastructure capable of handling international transactions outside American control. Each successful non-dollar trade demonstrates feasibility. Each additional country joining alternative systems strengthens networks through positive feedback loops. The critical question is whether dollar decline represents temporary adjustment or permanent structural shift. Multiple factors suggest the transformation is irreversible, regardless of American policy responses. First, infrastructure investments create path dependencies. Countries that built CIPS connectivity, signed currency swap agreements, and integrated with alternative payment systems won't abandon these investments to return to dollar dependence. The sunk costs are substantial and the strategic benefits are ongoing. Second, political dynamics prevent a reversal. Chinese officials who recommended Treasury diversification to protect against potential American sanctions cannot reverse course without appearing to have been wrong. This would be politically fatal in systems where leadership legitimacy depends on appearing consistently correct. Similarly, Chinese public strongly supports policies reducing dependence on American-controlled systems. Third, demonstrated precedents strengthen rather than weaken over time. Each country that successfully diversifies reserves or conducts trade in non-dollar currencies proves to others that alternatives work. This creates bandwagon effects, where initial successes attract additional participants who further strengthen alternative systems. Fourth, geopolitical drivers show no signs of moderating. US-China strategic competition continues intensifying. American use of financial sanctions as foreign policy tools expands rather than contracts. Each new sanctions target provides demonstration to other countries that dollar dependence creates vulnerability they can mitigate through diversification. Most fundamentally, the United States cannot easily rebuild trust once it's been shattered. Even if Washington wanted to reassure countries that future reserves would be protected, past actions have destroyed credibility. Once Russian reserves were frozen, every other country recognized that similar actions could happen to them regardless of current assurances. You cannot unring that bell through promises that circumstances have already contradicted. January 15th, 2026. Federal Reserve officials testify before the Senate Banking Committee that reduced foreign demand for treasuries will likely require increased Fed bond purchases to prevent interest rate spikes that would make deficit financing prohibitively expensive. The testimony acknowledges what market participants have understood for months. The United States will increasingly monetize debt through central bank purchases when foreign buyers step back. China's $500 billion Treasury extraction over 12 years wasn't portfolio management or routine rebalancing. It was systematic elimination of strategic vulnerability that American policymakers had dismissed as impossible because mutual dependency appeared to constrain both sides equally. But China concluded that short-term losses from reducing holdings were preferable to long-term risk of total asset seizure through financial warfare. The calculation proved correct. Chinese Treasury reduction accelerated most dramatically after February 2022, when Russian reserve seizures demonstrated that even central bank assets weren't protected under international norms that everyone assumed were inviolable. Each country observing these events drew obvious conclusions about their own reserve safety. For the United States, the implications are sobering. Dollar dominance enabled persistent trillion-dollar deficits without immediate economic adjustment. Foreign willingness to hold dollars and Treasury securities regardless of American fiscal discipline allowed consumption beyond production for decades. But that willingness is eroding as China and other countries build alternatives that reduce dollar necessity. The mathematical problem has no painless solution. If the Federal Reserve doesn't monetize debt, interest rates spike and trigger recession. If the Fed does monetize debt, inflation erodes purchasing power and imposes real costs on populations. Either way, the era of cost-free deficit financing through foreign treasury purchases is ending. For China, the extraction represents recovered autonomy after decades of dollar dependency. By diversifying reserves and building alternative financial infrastructure, China eliminates leverage that Washington weaponized repeatedly through sanctions and payment system controls. The protection costs hundreds of billions in potential treasury returns, but provides insurance against catastrophic asset loss that Russia experienced. The broader transformation extends beyond bilateral US-China relations to fundamental restructuring of international monetary architecture. The post-1971 system, where dollars dominated all aspects of international finance, is transitioning toward multipolar arrangements where regional currencies serve increasingly large shares of global trade and investment. This transition won't be smooth or rapid. Dollar dominance accumulated over 50 years won't disappear in a single decade. But the direction is unmistakable. China's $500 billion extraction demonstrated that systematic de-dollarization is feasible, desirable, and irreversible for countries seeking strategic autonomy from American financial leverage. And once that demonstration succeeds, the psychological foundation sustaining dollar dominance crumbles permanently. Other countries recognize they have choices. They can diversify reserves, settle trade in multiple currencies, and reduce exposure to systems that prove vulnerable to weaponization. Each decision to pursue alternatives weakens network effects that previously made dollar dominance self-reinforcing. The $500 billion isn't just money withdrawn from treasury markets. It's proof of concept that the dollar system isn't inevitable or unassailable, and that proof may ultimately matter more than the dollars themselves.